All right, welcome back to Finance Insight, everybody. I'm Big Joe.
And I'm Mary, ready to tackle a listener request.
Yeah, so buckle up. We're diving into the world of Forex trading.
Specifically, breakout strategies.
Breakout strategies. Now, you might have heard about breakouts and thought, oh, that sounds exciting. Lots of action, quick profits.
Right.
Well, hold on a second, because today we're going to go beyond the hype and really unpack what breakouts are, why they can be risky, and most importantly, how to approach them with a strategy that might just surprise you.
Exactly.
That's right. We're taking a deep dive approach thanks to the insights from BabyPips.com. And I think you'll find their perspective quite interesting.
Yeah, that's a good one.
So let's start with the basics. What exactly is a breakout in Forex trading?
Well, it's all about those moments when the price of a currency pair breaks free from its established boundaries.
Okay.
Imagine a currency pair has been trading within a certain range, like a caged tiger pacing back and forth. Suddenly, it bursts through those boundaries, signaling a potential shift in the market.
So it bursts out. Got it.
That's a breakout. And BabyPips.com tells us it could involve breaking through support and resistance levels, exceeding pivot points, or pushing past Fibonacci levels.
So it's not just about random price movements. It's about understanding those key levels where the market has historically shown some tension.
Exactly.
Okay.
And this is where the concept of volatility comes into play. Now, I know many traders are drawn to volatility because it feels exciting. It's like riding a roller coaster.
Sure.
But here's the thing. As much as we love the thrill, high volatility can be a double-edged sword.
Yeah.
You got it. While it offers the potential for rapid gains, it also carries the risk of rapid losses.
So it's high risk, high reward.
Exactly. Think of it like this. If a currency pair is highly volatile and breaks out, the price can move quickly in your favor. But it can just as easily reverse direction and leave you with a significant loss.
Oh, wow.
It's like trying to catch a falling knife.
That's a vivid image. So high volatility is definitely something to be aware of.
Yes, definitely.
Now, this brings us to a crucial point about Forex trading. What's fascinating here is that, unlike in stocks or futures, you can't see the volume of trades happening in Forex.
That's right.
And that makes a big difference, right?
Absolutely. In stocks and futures, volume is a key indicator for spotting good breakout opportunities. A surge in volume often confirms the strength of a breakout.
Okay.
But since we don't have that volume data in Forex, we need to be extra cautious. We're essentially navigating without one of our key instruments.
So how do we make smart decisions about breakouts in Forex, given this lack of volume information?
Well, that's where the BabyPips article offers a rather counterintuitive approach. And it's something I think you'll find intriguing.
Okay, lay it on me.
Instead of chasing those high volatility breakouts, they suggest focusing on currency pairs with LW volatility.
Wait, low volatility? That sounds almost backwards. Aren't we looking for big price swings?
I know, it might seem strange at first, but think of it this way. When a currency pair has been trading in a tight range for a while, that pent-up energy can lead to a much more powerful breakout when it finally occurs. It's like a compressed spring. The tighter the compression, the more explosive the release.
Oh, I see. So we're not looking for the wild, erratic movements. We're looking for the quiet before the storm.
Yeah.
Those moments of stillness that precede a significant move.
Exactly. And by focusing on low volatility breakouts, we might be able to avoid some of the false signals and whipsaw movements that can occur in highly volatile markets.
That makes sense. So how do we actually identify these low volatility setups? Are there specific tools or indicators we can use?
That's a great question, and it's something we'll definitely delve into as we continue our deep dive. But before we get into the nitty-gritty of those tools and indicators, let's take a step back and revisit those key levels we talked about earlier, support and resistance.
Okay.
These levels are crucial for understanding breakouts because they act like psychological barriers in the market. Oh, interesting.
Imagine them as battle lines between buyers and sellers. Support is like the floor, where buyers tend to step in and push the price back up. Resistance is like the ceiling, where sellers come in and push the price back down.
So when the price breaks through one of these levels, it's like a signal that one side has won the battle.
Exactly. And that's why breakouts through these levels, especially in a low volatility environment, can be such powerful trading signals.
I see.
They suggest that the balance of power in the market has shifted, and we might be in for a significant price move in the direction of the breakout.
This is really making me rethink how I approach breakouts. It's not just about chasing excitement, it's about understanding the underlying forces at play.
Absolutely. Breakouts are about strategy, patience, and recognizing the subtle clues the market provides. Very interesting. So we've laid the foundation for understanding breakouts and the role of volatility. We've also touched on the importance of those key levels, support and resistance. But how do we put all this together into a practical trading strategy? How do we identify those low volatility setups and actually trade breakouts effectively?
Well, that's precisely what we'll be exploring in the next part of our deep dive. So stay tuned, because we're about to get into the nuts and bolts of how to make this low volatility breakout strategy work for you.
All right, I can't wait. Welcome back to Finance Insider, everyone.
We're ready to continue our exploration of breakout trading and Forex, and I'm excited to delve deeper into the low volatility approach we touched on earlier.
Yeah. You had me intrigued with this idea of looking for those quiet, almost dormant currency pairs.
Sure.
Those that have been trading within a tight range.
Right.
It's almost like we're searching for the market's hidden gems, those breakouts that pack a real punch.
Exactly. And to identify these low volatility setups, we need to understand how to measure volatility itself. What's fascinating here is that there are various tools and indicators we can use, but one of the simplest and most effective is the average true range, or ATR for short.
Now, I've heard of ATR, but I'll admit I haven't fully grasped how to use it effectively.
We'll think of ATR as a way to gauge the average price range of a currency pair over a specific period. Let's say 14 periods, for example.
Okay.
So the higher the ATR value, the more volatile the pair has been recently.
So a high ATR is bad.
Precisely. A high ATR suggests wider price swings, while a low ATR indicates tighter price movements, suggesting that quiet period we're looking for.
And if we're specifically seeking low volatility setups, we'd want to see a relatively low ATR value.
Exactly. It's like finding a calm sea before a potential storm. We're not looking for the choppy waters. We're looking for those moments of stillness that precede a powerful wave.
I like that analogy.
And this is where those support and resistance levels we discussed earlier become even more critical. Remember, support and resistance act like those psychological barriers in the market. Support is like the floor where buyers tend to step in, and resistance is like the ceiling where sellers come in.
Right.
Exactly. And in a low volatility environment, these levels tend to hold even more weight. They become like magnets, attracting the price towards them.
Interesting.
So when we see a breakout occurring through a significant support or resistance level, in a currency pair with a low ATR, it's like a signal flare. It's telling us that something might be brewing, that the market is about to make a move.
So it confirms the breakout.
It's like that moment when a pressure cooker finally releases its steam.
I see. And speaking of putting it all together, how do we actually translate these low volatility setups into a trading strategy? Are there specific patterns or approaches we should be looking for?
Well, one popular strategy is to wait for the price to break out of a consolidation pattern, like a triangle or a rectangle.
No, I've seen these patterns on charts before. But I'll admit, I'm not always sure how to interpret them.
Well, imagine a triangle pattern, for example. It's like the price is bouncing back and forth between converging trend lines, getting squeezed tighter and tighter.
Okay.
And when the price finally breaks out of that triangle, it's often like a release of that pent-up energy, signaling a potential continuation of the previous trend.
Oh, so the price is building up energy within that triangle.
Exactly. So if the price breaks out above the upper trend line, it suggests a bullish continuation. And if it breaks below the lower trend line, it suggests a bearish continuation.
So we can use these patterns to predict the direction of the breakout.
Exactly.
And if we're focusing on low volatility breakouts, we'd ideally want to see these patterns forming in a currency pair with a low ATR, suggesting that the breakout could be more significant.
Precisely. So we're combining the power of those patterns with the added confirmation of low volatility.
So we're looking for both the pattern and a low ATR.
Exactly.
Got it.
It's like having two pieces of evidence that point towards a potentially strong move. But even with these strategies, we can't forget the importance of risk management, especially in the world of Forex trading.
That's where stop-loss orders come in, right?
Absolutely. Stop-loss orders are like our safety net. They automatically close out our trade if the price moves against us beyond a certain point, helping to limit our potential losses.
So they prevent us from losing too much money.
Exactly. And this is especially crucial in breakout trading, because even though we're looking for those low volatility setups, the market can still be unpredictable at times.
Gross.
Exactly. Volatility, even in its quieter forms, can still turn against us. That's why managing our risk is paramount.
It's all about protecting ourselves.
Yes.
Now let's shift gears for a moment and explore another approach to breakout trading. One that might seem a bit counterintuitive at first.
Oh, I'm intrigued. What's this new twist?
It's called fading the breakout.
Fading the breakout. Now that sounds interesting. Aren't we trying to capitalize on breakouts, not fade them?
Well, the idea behind fading a breakout is based on the fact that breakouts can sometimes be false signals, also known as fakeouts.
You mean those moments when the price seems to break out, but then quickly reverses direction and traps traders on the wrong side?
Exactly. It's like a head fake in basketball. And that's where fading the breakout comes in.
Okay.
The strategy involves waiting for the initial excitement of a breakout to die down, and then entering a trade in the opposite direction.
So if the price breaks out above resistance, we'd actually look to sell short once the momentum fades.
Precisely. Of course, this strategy requires careful analysis and a good understanding of market psychology.
Yeah.
It's about recognizing those moments when the market might be getting ahead of itself, and then capitalizing on the potential reversal.
Exactly. It's a more nuanced approach to breakout trading, one that requires a bit more experience and finesse.
This is not for beginners.
Right.
Okay.
But if done correctly, feeding breakouts can be a very profitable strategy, especially in those volatile markets where fakeouts are more common.
Interesting. So we've got two main approaches here. Buying breakouts, which is more straightforward but requires careful selection of low volatility setups, and fading breakouts.
Yeah.
Which is more nuanced and relies on spotting those fake out moves.
Exactly.
And the best approach for any trader will depend on their individual trading style, risk tolerance, and market analysis skills.
Exactly. There's no one-size-fits-all solution in trading. It's about finding what works best for you.
I think that's a really important point. There's no magic formula. It's all about understanding your own strengths and weaknesses.
Absolutely.
This has been an incredibly insightful exploration of breakout trading so far. We've covered the importance of volatility, the power of support and resistance levels, and even explored some advanced strategies like fading breakouts.
And we've only just scratched the surface. There's so much more to learn about this fascinating area of Forex trading.
Well, luckily for our listeners, we're not done yet.
That's right.
In the final part of our deep dive, we'll be sharing some more specific tips and techniques for identifying high probability breakout setups and managing your risk effectively.
We'll also discuss the psychological aspects of breakout trading. Because let's face it, this style of trading can be a real roller coaster of emotions.
I can definitely attest to that.
So stay tuned, folks, because the grand finale is just around the corner.
Welcome back to Finance Insider, everyone. We're about to wrap up our deep dive into breakout trading in Forex. And I'm ready to equip you with some more practical tools for your trading arsenal.
And I'm excited to share some insights that might just shift your perspective on how to approach these exciting yet potentially risky trading opportunities.
Yeah, we've covered a lot of ground, from the importance of volatility and those crucial support and resistance levels to exploring different strategies like buying breakouts and even fading them.
Right.
But before we send our listeners off to navigate the Forex markets, let's dive into some specific tips for identifying those high probability breakout setups.
Sounds good.
You mentioned earlier that we should be looking for low volatility environments. But are there any specific patterns or indicators that can give us an extra edge?
Absolutely. One classic pattern that comes to mind is the head and shoulders formation.
Yeah, I've heard of this pattern, but always found it a bit intimidating. Can you break it down for us?
Well, imagine you're looking at a price chart and you see a pattern that resembles a head with two shoulders on either side.
Okay.
The head is a peak that's higher than the two surrounding peaks which form the shoulders, and connecting the lows between the head and shoulders is a line called the neckline.
Okay.
So when the price breaks below the neckline, it's like a signal that the market is losing its strength. We could see a bearish breakout.
Oh, okay.
Exactly. And conversely, an inverse head and shoulders pattern where the price breaks above the neckline can indicate a bullish breakout.
So we're looking for these patterns to form in a currency pair that's been relatively quiet with a low ATR, right?
Precisely. It's like finding that calm before the storm, but with the added confirmation of a classic chart pattern.
That makes sense.
Yeah.
Now, are there any other indicators we can use to confirm these breakouts?
Another powerful tool we can use is the moving average convergence divergence, or MACD indicator.
Now, I've heard of MACD, but I've always struggled to understand how it actually works.
Well, think of the MACD as a way to measure momentum and potential trend reversals.
Right.
It consists of two lines. The MACD line itself, which is the difference between two moving averages, typically a 12-period and a 26-period moving average, and the signal line, which is a 9-period moving average of the MACD line.
Wow, that's a lot of numbers.
So when the MACD line crosses above the signal line, it can suggest that buying pressure is increasing and we might see a bullish breakout.
Yeah.
And conversely, when the MACD line crosses below the signal line, it can indicate selling pressure and a potential bearish breakout.
So we're basically looking for those MACD crossovers to happen in a low volatility environment, potentially near those key support or resistance levels we've talked about.
Exactly. It's about combining different pieces of information, like a detective gathering clues to solve a case.
I like that analogy.
Remember, no single indicator or pattern is foolproof. It's all about understanding the context, analyzing the bigger picture, and using these tools as guides.
Right, it's about putting all the pieces together.
Exactly.
And speaking of the bigger picture, let's not forget the psychological aspects of breakout trading.
Right.
You mentioned earlier that this style of trading can be a real emotional roller coaster, and I think that's an important point to highlight.
It's true. The excitement of chasing those big moves, the fear of missing out, the frustration of getting stopped out, it can be a whirlwind of emotions.
It definitely can be.
And that's why having a solid trading plan and sticking to it is crucial.
Makes sense.
A plan helps us stay disciplined and avoid making impulsive decisions based on our emotions.
Right.
It's like having a roadmap to guide us through the ups and downs of the market.
I see. So having a plan can help us stay grounded and make more rational decisions.
Exactly.
And another crucial element, as we've touched on before, is managing our risk effectively. Stop loss orders are our best friend in breakout trading.
Absolutely.
They protect us from catastrophic losses if a trade goes against us, and they help us preserve our capital for future opportunities.
That's right.
And it's not just about limiting our losses, it's also about protecting our profits.
Right.
Consider using trailing stops to lock in gains as the price moves in your favor.
Trailing stops are like a safety net that follows the price as it rises, ensuring we capture a good chunk of the move without getting greedy.
So they help us maximize our profits while still managing our risk.
Exactly.
Now, as we wrap up this deep dive, one final thought for our listeners.
Okay.
Breakout trading, like any trading style, requires practice, patience, and continuous learning.
Absolutely.
Don't get discouraged if you encounter some bumps along the way. Keep studying, refining your strategy, and never stop seeking knowledge.
That's right. Embrace the journey and remember, knowledge is power, especially in the dynamic world of finance.
Well said. Keep learning, keep exploring, and never stop seeking those breakout opportunities.
This deep dive has been an incredible journey, and I hope our listeners feel empowered to approach breakout trading with more confidence and a strategic mindset.
Absolutely. Remember, trading is a skill that's developed over time. So be patient with yourself, keep learning, and enjoy the process.
And that brings us to the end of our deep dive into breakout trading in Forex. We hope you found it valuable and insightful.
We'd love to hear your thoughts. What resonated with you the most? Are you feeling more confident about tackling breakouts? Share your takeaways and let's continue the conversation.
Until next time, folks, happy trading.